Moving on from large orders and how to trade a real large order, we're now going to look at large orders that are not. Large orders that are put there to get the market to do something, to get people to react, as we saw with real large orders. But instead, once they've created this reaction, they are then pulled. This is an act of what you call flipping or spoofing. I'll try and draw a small distinction between the two in a moment. But the idea behind this is it's a manipulative practice. It is illegal. Don't attempt to do it. You will get yourselves in a significant amount of trouble, first thing to say. But people do it. And rather than look at this, as many people do, and say, oh, well, it's the algos that are beating me, people are flipping markets, and that's wrong, they shouldn't be allowed to do it. Maybe so. They do it anyway. So you then have to look at it and ask yourself, right, well, how can I make some money out of this? Because the person doing the manipulation, doing the flipping, is doing this for a purpose, to make some money. So there's a way that they're doing that. If you can work out how they're making the money, you can make your money out of it without doing the illegal part. And that's the art of recognizing these types of patterns. There is no need for charts, so there won't be a great deal to see. It will all be just seeing this on ladders. There's no way of knowing from a chart where this will happen. But there are characteristics, and I'll show you just two charts in this one, of the volume spikes that you will often see around a flipping or spoofing period of time. We'll look at this a bit in footprint as well, and I'll show you some of the examples that I might use. I'll then show you variants of this when we look at it from the perspective of a footprint as well. So, how exactly can people go about doing this? What are the distinctions between a flipped large order and a spoofed market? Let's go and have a first look. So, few different distinctions, and the whole point of what people are trying to do is they're enticing trade. That's what they're trying to do. They're trying to influence action and then using that action to get themselves filled. Now, there's a few different ways that people will do this. We'll come to flipping last. That's the most basic. First up, spoofing. Now, to draw a distinction, the way I would interpret a spoof is where somebody puts a large order on to get the market to trade the next price. Now, whilst this is illegal, they may not be doing this purely in an attempt to make money by the act of spoofing the market. It may well be a case, for example, where somebody is long, the market is approaching their offer where they want to get out, and they will put then a very large bid. By pushing the large bid up the book, this gets people to buy. And as people buy into that person's offer who's already long, they get out. As soon as they're filled, they pull the large order. This traps people. Your reason to be in the trade has suddenly evaporated, and so therefore you have to get out. So that's one way that spoofing can take place. And this can often be seen, when you have a more directional move and orders will then follow it in and then seemingly disappear. That would be an act of spoofing to try and get the market to trade the next 2 or 3 prices. Next comes the much more nefarious versions though, where people are doing this purely in an attempt to make money. So we start off with flipping. This is the most basic act. The way flipping works is somebody will place a large order, and I'll give you a sort of stepped example of this in a moment. Someone will place a large order, let's say on the bid, with the intent of getting other traders to now buy at market into the offer. The idea here being that if you were tempted to buy, as we talked about with large orders, you're now forced to pay a higher price because that price you were looking to buy now has a very big queue at it. So people then hit market, but the person doing the flip, the person with the large order, is also on the offer. So they get filled on the offer, and as soon as they get filled, they pull their large order. So now anybody who's been buying because of the large order has just had their reason to be in the trade completely taken from under them. So the front run is not a front run anymore. So they're now long, needing to get out. The flipper will then put a large offer, meaning that you can't wait for a scratch if you've just bought, because now you have a big offer at the price that you have just paid. So now you have to pay down 1 tick to get out. You sell, you take a 1 tick loss, the person doing the flipping has got the other side of the trade. They've made a 1 tick winner, potentially on 100, 200, 300 lots. And this is how the very basic version of a flip works. So it's all about trapping people. It's all about forcing action, essentially. The same is the case with a layering or a stacking type of manipulation. This is a more longer term idea, or when I say longer term, across more prices. So this may happen over 5, 6, 7, 10 prices. The market will get pushed up and the order book on one side will seemingly increase. So you may get a significantly large number of bids on the one side of the market. Not necessarily really obvious like a large order alone, but instead numerous large orders or increased large orders. Then the market will hold and reverse through them. So they're wonderful to trade because it gives you a very clear target where those large orders have been stacked to. You go back down through those large orders. So we'll come on to this in a moment. The whole point of both of these is to get a perception of strength or a perception of weakness. Get people to act on this, to feel that they need to do something right now in order to get the trade that they want. And if they don't act right now, they're going to miss out. So this traps people. Once people are trapped, then the person doing the manipulation, the spoofing, the flipping, turns the market over. All of those trapped people run for the exits and get out. Generally, the people who are trapped are shorter time frame traders because we're the people who react to small order flow anomalies, little pieces of action like we saw with large orders. Doesn't mean don't trade any large order. It means be very aware of what's going on around it. And the key to any kind of flip or spoof is the other side of the market, the absorption. I'll illustrate this when we get into a few of these different examples, but the absorption is critical. If you see a large order and a market absorbing on the other side, so say a large bid and the offers continually reload, this is a good indication that large bid, particularly if it has just appeared, is highly likely to be false. And so you can then join the absorption, classic iceberg partnering idea, join the absorption, the large order gets pulled, and you can take your 1 tick winner, 2 tick winners. So it's very sort of short-term tick, tick, tick scalping strategy, but can be done on a very significant amount of size. So that's the key. It's all about what's getting filled on the other side. In terms of knowing where this might happen, as I say, you can't see this on a chart. You can't predict it from a chart. You can, to a slight degree, predict it by way of time and volume. Periods where the market is quieter, lunchtime, periods where volumes are lighter, bank holidays, things like that, late on in the session, post-cash sessions. These are the times where this can happen because there are less larger participants to take on the spoofer. So if you put 1,000 lot bid on the S&P in the middle of the cash session or right at the open, quite probably someone will need to, if they've got 1,000 lot to sell, they'll see that 1,000 and go, brilliant, there's some liquidity, sold. So the person doing the flipping now is long 1,000 when they don't want to be. So these types of actions will generally happen in periods where the market is quieter, where the person doing the manipulation is less likely to get hit by other market participants. There's a great book if you want to go and read about this type of thing. It explains sort of specific strategies. It's called Flash Crash. It documents the journey of Nav Sarau, who developed a flipping algo. So if you want to understand a little bit more nuance, you can go and look at that. But the point here is we need to understand how you make money out of this without doing the illegal part of it. So first up, we'll start basic flip. And this is nice and simple. The way a basic flip works is you get a large sell order in this example. So we're going to use a large sell order. This order appears. This is an example in gold. You can see this in all sorts of different markets. As soon as this order appears, 100 lots in gold is pretty significant. Traders front run it. So they now start to sell 60.6, 0.5, 0.4. They start hitting the bid at market. Whilst this is happening, we've now moved from an offer at 0.6, we're now offer 0.5, it trades 0.4, you've now got bid at 0.3. The flipper is getting long. So the person with this order here is quite probably some of these larger bids as the market falls down. So they start to get filled. You see also down here, the volume increasing. So not only are they some of these larger orders, they're also reloading these as well. This is crucial. Seeing that reloading is saying to you, somebody is picking up all of the sellers. As people come in to sell at market, somebody is sitting there and just reloading bids, increasing their position. So next up, the large order disappears. Anybody who's now sold, and look at the volume done down here, around about 50 lots on every single price. So this person could have picked up potentially 250 contracts down here in gold. They could have picked those up at an average price maybe of 0.4. They pull the large order. So now, anybody who has sold down there, ahead of that large order, expecting this to drive the market lower, is completely trapped. What do you do in that situation? Well, if your reason to be in a trade has gone, you get out. So now, all the people who sold 7, 6, 5, 4 are now thinking, get out before I end up offside. And some people may well get out for a scratch, or maybe a 1-tick winner. But this gives a situation where people now come and start to buy. Where do you think the person doing the flipping is? Well, they're now going to be these offers, or a large proportion of those offers. So as the market now flips back up and trades back, they get filled on the way back up and then place the large order on the other side to get people to now buy. And as people who had sold 6, 5, 4, 3, those who didn't get out and are now thinking, maybe I should have got out, are now forced to pay higher prices. There's no way you're getting your scratch at 4 now, it would seem. So you now have to start to pay up and you hit 7, 8, 9, 01. That's the way that people are going to trade this. And so that's the idea of a basic flip. It's easy to see in sequence. You see the large order come on one side, absorption, large order disappears, large order flips back, market trades up. That's the basics of a flip in this way. So whenever you see, particularly, if you see a market where you see a large order appear, then it disappears, then it appears on the other side, even without trading that, you straight away can think there may be somebody trying to flip. Straight away, your thought goes to and needs to go to, right, next time I see a large order, what happens on the other side? Do you see absorption? Do you see the bids reloading when the large order is there? If you do, there's a very good chance that this is a false large order, it is going to get pulled, and the market is then going to flip back up, and you may well get something coming in on the other side as well. So let's go and have a little look at a couple of examples of a basic flip. First up then, a basic flip. I'm going to show you another variation. It is still a basic flip, but a much faster one, and we're going to go and have a look at this one in the S&P in a moment. First up though, look at the Bund. If pushed, I would say that you generally see more flipping and manipulation in European markets, Eurex products, than you do necessarily in US products, but that's not to say that it is exclusive, and I'm purposely going to give examples looking at Bund, cable, gold, S&P, DAX, FTSE, to show this happens across the board, multiple different markets. What you've got to understand is what your market looks like when it flips. So we're going to see a more subtle basic flip to start with in the Bund, and then a much more obvious one when it flips back the other way. So, simple way that you need to approach this. Large order appears. Wait for the absorption. That's the key part to this. Wait for the absorption. Once you see that, you can join it. This is the legal part of the trade. There's nothing wrong with you seeing absorption and joining. Stop-wise, as long as the market's not trading through that absorption, you're fine on this trade. So it may be 1-2 tick stop. It's like a standard kind of absorption trade. Target where the last large order was. So you can play for that, you can play for a couple of ticks above that if you want to try and layer orders up and scale the position out. Your risk on a trade like this, aside from defined by a stop, is also if the market doesn't move when that flip order disappears. That's the risk on the trade. And I'll show you what I mean by this when we look at a false flip in just a moment. So let's go and have a little look at this one. Here we go. Nothing going on just at the moment. This is the Bund trading 41, 42s area. Not too much going on. What we're watching out for, in the first one, we're going to see a larger offer appear. When that large offer appears, you can then view that as your opportunity to start to buy. But at this moment, not a great deal going on. So still 200s, 300s, there we go. All of a sudden, 500 appears on the offer. There's your potential flip. Now, for somebody to see that and straight away get on the bid, this is obviously not the first time that they've seen it. They've seen this person do this perhaps once or twice already in the day. So, what you want to watch out for now is the absorption that takes place. So you trade 30 up, there we go, another 190 down. So quite significant hits down, more reloading here. So this is exactly what you're looking for. Somebody clearly is absorbing here ahead of the large order. So the large order is not creating the directional move one would expect. Boom, disappears, pop, pop up, and that's your trade done. You buy 39, you get yourself out of 40, 41, potentially 42. This is where you have to make a decision. Are you going to wait for it to lift up to 42, or do you just want to get onto the offer at 40 and take your one tick winner? This is a case of seeing these numerous times and seeing how much you think you might be able to get out of it. If it is a case of one tick, take your one tick. And so we see it then trade up, tick ticks up. And this is then what I would call the kind of spoof side of it. Note the difference here. You don't get a huge amount of absorption. Instead, this 1,000 lot is there to instigate a bit of trade, potentially to get the person filled who bought down at 39. As the market ticks up, they may have some left, and the 1,000 lot is there to get people to buy to fill them their last bit. So there we go, little trades, not a great deal. 1,000 lot disappears. You can actually have a go at shorting that there because where the 1,000 lot was, with the view that you can get out exactly as I say, just where that 1,000 lot was, take your one tick winner. It's a very simple trade. It's a very short-term trade, but it's giving you a clear reason that you want to buy, a clear reason to sell, and a very clear risk reward on the trade. It may only be 1-to-1 on your risk reward, but if you see this consistently, this can be a trade where you potentially can have an 80-90% win rate on. And that's where the value of a trade lies here. Unlike many other trades, this is perhaps one of the strategies, order flow plays, that is going to give you the highest win rate when they work. So we've seen a very basic flip. This illustrates exactly what you're looking for on a basic flip. What we're going to go and have a look at now is a fast flip. Seeing a market then, in this case, actually move upwards, and as it moves upwards, the market flips back down, flips back down, flips back down, and you watch the size come in on this. I'll show it fast the first time, and then we'll pause it along the way the second time. Let's bring that one up. Here we go then. It's the S&P. This was when we were trading quite significantly lower in price, but nevertheless, the point is the principle of what goes on. Very similar look to what we're currently trading. Watch where the large order appears and then disappears. This, as I say, is much, much quicker than what we have seen with the Bund one. Very specific over 1-2 prices. There we see 1700 on the bid, disappears, market flips back down. And you see it moving down. As soon as you ever see a large order that disappears down the book, that rolls away, this straight away is an indication of somebody spoofing. You see there, it's moved up and then it moves back down, and it moves up and it moves back down. It keeps appearing down towards sort of 43.5, bang, bang, up we go. And there's actually now 2 large orders. So we just push the market up very quick and then it flicks back very briefly. This now sets the tone. If you saw that just once, you now can see the same principle again. You can have a go at selling up here around about 47.75, and you can almost now start to hover your mouse over those prices, expecting each time it jumps up to be able to sell into that order. And that's the way that you want to try and approach this now. It's about seeing each little flick up as an opportunity to sell. There we go, sell again. Your orders go in where that large order was to try and take that 1-2 tick winner. With the speed of this as well, you do get that opportunity potentially to get more than 1 tick out of this. You see there again, large order appears, you can sell more again and get that flick back towards the downside. That's how you're going to try and approach this. So it's a much quicker piece of action. We'll take us back to the beginning on this one. And we'll pause it along the way at different points where you can see what's going on. So what we see here, market staying reasonably stable. Now, nothing to be noted, but there we go, straight away. So if you look at the prices this comes in, 46.5 the first time, and you get 1,700 contracts. You see that the first time, you think large order, and quite possibly you'll buy and you'll lose a little bit of money here. But immediately disappears. Market drops back down, 46.5, 45.5, and the large order is now all the way down here, 43.75. So this is pretty irrelevant. A large order that far from market is not going to tell you a great deal of anything. There we go, back up it goes, 45.75. And the market then does flick back down very briefly. But also what you want to be looking at now is when the large order appears, how many prices away from it does it trade? You can see here, when it appears once again now at 46.25, you've got the opportunity to sell 46.75. So you've got 2 prices just to get back to the large order and potentially 3 to get back through that. So you now get a sense as to what you're looking for. There we go, trades down. So if you put your bid where the large order was, that's going to allow you out of the trade. So now you can see the theme. You know what you're looking for now. And we know that you're after this large order. As soon as you see it, there you go. You can now jump on the offer, 47.5. The large order's moved up to 47 this time. You can jump on the other offer or even hit market, 47.5, 47.75, with your intent to take 2-3 ticks out of this one once more. There it goes, disappears. You can get out at 47. So if you've seen this a couple of times, you can be very ready for this. And there we go, same principle again, appears at 47, disappears, and it's getting faster and faster and faster. That allows you once more, get out of the trade. You can even start to leave offers, preempting this flick up that we see. So now you're looking, right, where does the next large order appear? Now we get 47.5. So this large order is moving up. But each time it's moving up and it's trading perhaps 2 to 3 prices ahead. And then you've also got the opportunity to get out where that large order is. So there we go, flicks back, 47.5, you can actually get out of 40, by selling 47.75, 48, you can actually take a full 4 prices out of this one. And there we go again, this time 47.25. You see what's going on, nice and quick, flips it up, flips it back, flips it up, flips it back. What I'd hope that some of you will have noticed here is that this large order each time is actually decreasing in size. The first time we saw it, it was around about 1,700 contracts. Now, it's down to around about 1,000. And we see again, same prices, 47 3/4. But you can now get filled 48 1/4, waiting for this market to come down once again. And so what's potentially happening here, and you're never going to know this, but what you can start to see is the value of this is diminishing because the large order is actually getting smaller and smaller each time it comes in. What this could be an indication of is that this is actually quite a cunning way of somebody executing a long position. What they're doing, by pinging the large order in, there we go, 850 now, and that comes in at 48 1/4. By hitting the large order in, what they potentially are doing is they're buying the next two prices and put the large order there. As people recognize that this is clearly getting pulled each time, they now start to sell, which gives the person looking to buy more liquidity. So whilst it shows initially that they tried with 1700, it may be that on each rotation up, each flick up, they're hitting market for say 200 and then also getting filled 200 as it comes back. They then do the same again with a slightly smaller order because they're using that order. As it hits up, they hit maybe 1,000 at market and then move the 800 up. And so that way it creates this perception of the market flicking up and flicking back, but all the time they're trying to buy more. And so as you see this size diminishing, this is a good indication to say to yourself, right, I don't want to be continuing to take this trade on because clearly this is a market that is running out of the ability to create that jump up because the large order that is flipping the market is actually decreasing in size each time. So it's an additional thing to consider. But on the whole, this is a trade where you're noticing that pattern, that each time the large order flicks up, the market stalls, it pulls, and it drops back down. And with the very quick ones, you don't need necessarily to be quite so accurate in terms of seeing the absorption happening over and over. It's more a case you see it flick up and it stalls, that's your absorption, and then it pulls and the market flicks back. You've got a little bit more variance. You have the ability to perhaps to take 2 or 3 ticks when it moves up. There we see it's 500 now, 2 or 3 ticks when it moves up, and you can then take that back. So you get more scope to play the move back. That's where the value is on a trade like this. And you see continued movement, trying to sell 48.5. The large order decreases again, but you still each time see in this flip of around about 2 or 3 ticks. The danger here is then trying to play the other side, and people do get tempted to do this. But when you see this large order keep on pushing the market up, as it pulls back, you can then try and buy on the basis that the large order is also going to flick up again. The danger of that, of course, is that if this large order doesn't come back, you now have a long position with absolutely no idea where you're wrong. At least with the large order, you know where you're wrong. It's where it flipped the market to start with. If it doesn't keep going, then, or sorry, if it doesn't roll back, then you know you can get out of this trade. So there you have it. Basic flip, fast flip, simple principle. The large order gets people to trade one way, it pulls, the market jumps back the other. What we're going to have a look at now then is this part, number 6, your risk. What happens when a market doesn't move when the flip order is pulled? So take a situation like this Bund one, market trades down, you put the large 500 lot on the offer, the 500 pulls and nothing trades up. When that happens, you could be in a situation where you actually have what would be called a false flip, and a market that has shown people one way and then pulled the rug the other. This will be something that can occur once people start recognizing the flip. Then the person doing the flipping will then start to drive the market against them. So let me explain this. Here we go. False flip then. Basic activity, it works the same. So you get flip, this creates a movement in one direction. So you get the large order, market goes down, let's say, trades down, large order gets pulled, market trades back up. Brilliant, you now have recognized the flipper. So people start to recognize the opportunity, they start to jump in. The difficulty is the opposite direction flip doesn't work. So let's say, for example, you have a large order that sends the market down and then pulls and the market goes back up. When a large bid order is placed, the market trades up, this order gets cancelled and the market does not come back down. That's where your problem lies, because now it's more a case that the traders who have recognized the flip opportunity are now trapped. So it's trapping the people who have recognized the trap. You're now short, if I get my other pen, you're now short up here. This order disappears, you're expecting to get out down here. So you've got your bids down here ready to escape. That doesn't happen, and then what will happen is the market will trade up, trapping these people and creating a scramble towards the upside as they're forced out of the trade. So it's a trap to be aware of, and the key bit to a trade like this, and there's 2 key aspects here. One, when the counter direction flip appears, you don't see the absorption that you would expect. So when you get that, or when you don't see it, straight away this is a warning. Equally, when the large order disappears, you don't see any selling coming in. You don't see the market that then goes back towards the large order, it just stays still. Imagine what happens. You've seen this, you've sold up here, you placed your bid down here to get filled. You don't get filled. You're now sitting there thinking, will it go, won't it go? If the market goes tick upwards against you, now you're more on the defensive and thinking, I need to get out of this before it turns into a loser. And that's where people then get trapped and they get driven out of the trade as the market rises. So let's go and have a look at a few different examples of this. I've got a slower, more subtle one in the pound, another example in Bund, and I've got a much quicker version of this in gold, which is almost an element of recognition that you've not got the move you expect, and therefore you're going to get the more directional move. So let's start this off, and we'll begin this by looking at cable. So you can see here, this is the pound at the low of the day. Low of the day coming in at 87, so we're pretty close to a potential breakout point, and that's fine. What we're then going to see is this false flip in action, and watch the absorption. This is the key bit. So all the focus on these prices really 87 up to 91. That's where all of the action is going to take place. So here we go. You can see a larger order down here, and at this point you're thinking, right, well this could be something that limits the move down, like we saw with a large passive order resting. So at this point in time, nothing really to be taken from this. You're not going to make any great conclusions. You can still see a large order down at 82. A little bit of an absorption there at 89. Equally though, unless you really want to be short here, that's not much of a reason to want to be in a trade. So it's now just a case of you've got a reasonably stagnant market. We're not moving particularly quickly. Passive orders aren't moving. Now you see a large order appear on the bid and it moves up. But watch the offer now. As soon as that large order appeared, we just reloaded 235 contracts. So that large order then gets pulled. This is likely a flip. So you can now be short on this trade. Looking at this thinking, right, that's flipped it, we can go down. And you could well have just got out at 88 when this other large order appears on the offer. This looks like a classic example of a flip both ways. The difference here though, is that large order pulls itself up the book and the market does not absorb on the other side. So now you're getting a lot of info. That's your false flip because you didn't see the same action on both sides. Instead, what you saw was a large order on the bid creates absorption. A large order on the offer does not. 10 lots trades, 11 lots trades. Remember that when it was on the bid, it was 200. You actually see more trade into the offer in this situation than you did the other way, and the absorption continues. So this is now saying to you, don't believe this as a flip. The original one still holds 120, 140, 150, 177 lots trades now. So this is doing a massive absorption and bang, then it goes down. Straight down to that next large order, and you now have a new stack of large orders down here. So all the time you can now start looking at these large orders and how they move and the absorption that occurs around them. That's how a false flip works. It gets people to think there's a spoof, and rightly so the first time they see it. When they see that 100 lot originally appear on the bid and it gets the absorption going at 89, straight away you can be quite confident that this is a flip. Large order comes on, absorption, large order pulls, it's likely a flip. But when it comes the other way, it doesn't create the same reaction. That's the key bit to this. When you don't see the same reaction in the other direction, this is telling you the whole story, and it says to you, you want to pay attention to the original flip, there you go. You want to pay attention to that, that's the selling action that you need to see, that's telling you the whole story. And when the other flip doesn't get the action the other way, think about what's going on. If somebody has just put a large order and sold, let's call it approximately 250 contracts, and then they flip it the other way, even if they've got out of maybe 39, they've not done a great deal here, and then the large order disappears. And in fact, they continue to sell. So they might have got out of 36, say, and immediately they start to reload that price again. So the clear position created by that large order is a short. That's what they're playing for. They're playing for this breakdown using that large order. So there you have it. Simple false flip that creates a break of low, is used to instigate the break ultimately. It's somebody's attempt to get their business done just before the break happens, and it's exactly what they get. And they do it by enticing people to buy into their absorption by showing them a flip one way and a flip the other. So now people think that it's going to flip up. It's not. you trap the people who have worked out the trap them there, the market then drops down nice and quick. Classic example of a false flip, and there you have it. Next up, we're going to have a look at one in the Bund. This is one where the market pushes up, you see the large order disappear, and so less a two-directional false flip, but more one where the flip disappears and the action doesn't turn. That's the key bit to this one. So we'll bring this one up and we'll go and have a look at exactly what happens here. Okay, here we go then. Bund false flip. This is one where the market's looking reasonably stable. We've rotated slightly off the low. You can see that there's a large order down here. There's 829 lots at 44. But that's around about all you're seeing here. Not necessarily a particularly large order. I'll rewrite that because that's terrible writing. There we go. 829 at 44. We'll get this one moving and you'll see what happens here. So at this point in time, not a great deal doing, but you can see quite a significant amount of volume at 46. And so two directionally, absorption's reasonably even. You've seen the bids increase slightly at 44 and at 45. You now have 616 at 45. But still, this isn't showing you a great deal, and a little bit of absorption at 47. But there's not a great deal to take from this. You've still got some larger orders on the other side of the market as well. So nothing to jump to any major conclusions about. Now we see 1100 come up onto the bid. This is where people may well be tempted to start to sell. And they could consider selling at 49. But no, you don't see a great deal of absorption here. Not in the way that we saw down here. Thousands and thousands and thousands. Now the large order pulls. So you had 1150 at 47. That's gone. So anybody who did quickly join the offer, and you could only really join the offer at 49 because we skipped through 48. Anyone who joined the offer there is trapped. Or well, they're not necessarily trapped. They're short. They're waiting for the market now to drop because of that large order disappearing. But now we trade into 50. So anybody who's short is now feeling uncomfortable. 1,000 lot trades into 50. Larger order comes up. So this still keeps the perception of the flip going. And that turns into 800 lots at 49. And so anybody who's short 49 might be willing to now try and sell 50 as well. So you've got 802 at 49. And now that all disappears. So your reason to be short is evaporating. And at the same time, the market is melting up. Yeah, it's just trade 51, 52, it's trading 53. Very, very easy. And what this does, this traps people. If you thought you were safe down here at 49 to take 1-2 ticks back below 47, so 49 to 47, 46, maybe 3 ticks, winner, you're now looking at a 5-tick loss and wondering, do I get out of this now? Do I hope it comes back? You may well have also added at 51 when the 800 appeared. So you may now have double the position and this getting driven against you. And the key bit to this was when that large order appeared, you did not get a great deal of absorption at 49. And as soon as the large order disappeared, the first action was actually directly to buy into the offer. So it wasn't to turn down, it was actually to buy more. And as soon as that happens, you realize you're trapped. The way to think about something like this, as soon as you feel like you're trapped, get out of the trade. You're not looking for much on these trades anyway. So what you do not want to do, and one of the worst situations that you can have, is where you go from looking for a 2-tick winner to sitting on a 5-6 tick loser. If you don't get the movement that you're looking for almost immediately, then this is a warning sign. And taking a scratch on this type of trade is perfectly acceptable. Take your scratch, get out of the trade, don't run the risk that this is going to get driven against you. So here we have it, slightly more nuanced one in the Bund. This is one where it shows it one way and then pulls the rug and keeps on trading up. It could well be that the person, and you're never going to know again, but just to get you thinking about the mechanics of what may be happening, it could well be a realization from the person placing the large order that potentially they're not able to get filled what they want. As in, they may well have got on the offer and people don't keep on coming to hit them. So this person may well have got 30 lots short, maybe they get 100 short, and they don't get what they want. So they're now sitting there thinking, right, well, I'm 100 short, I'm going to pull this, and rather than wait for the market to flip back down, because they've not trapped many people, instead, they accept the scratch on the 100. So if you're 100 short at 49, you buy 100 to pull you back to flat, and then you buy more, maybe buy 500. By doing that, anybody who has expected the market to turn over is trapped. So those who thought that they'd got a smart idea on and have perhaps beaten the flipper to get in their fill are now trapped, and the flipper then drives the market against them. And that's what potentially is happening here. Like I say, you never know that that's the case, but the point being, if you understand the mechanics of how that can work, you can see the potential trap in both directions. And the key, as I say, this needs to turn back for you as the market stabilizes and then looks down. And if it doesn't, that's a big warning sign. Final false flip to go and have a look at, and this is one in gold to show you a quicker version of this as well. What we see in gold here then, is a large order appear on the offer. So there we go. This is the one at 60.8, and you start to see the absorption down here at 60.3, 60.4. Market stabilizes down at these prices. This gives you an opportunity to buy. And now you get the large order appears on the bid. So you're in a great position. We're long, got some offers in to get short, wonderful. Taking the flip, back up, get filled, get out of the trade. So you're waiting now, and you can leave orders in, and this is one approach to trading a flip. You can leave orders if you can see the range that this is trading. That large order disappears, but you get the absorption in the same place. So rather than this creating a huge movement down, you actually get absorption in the same place, and the large order is not generating the turnover that one would look for. You're also expecting a large offer to come in. This would be the pattern that you're looking for the market to get pushed down, push back, push down, push back. You don't see it. So now if you have got long, there's no reason to exit just here now, unless that other large order comes in, which was appearing in the sort of high 60, 61 area. If that doesn't come back, you can hold your position now, looking potentially for a breakout of the range. So there is an element with this one that there was a case of you see it go one way and back, and then if you can buy that bottom of range and the market doesn't then continue and the flip disappears, you're now in a situation where this could well release now. Because those who have seen this flip previously do not get the results they're looking for. You've now got another large order higher up the market. We can now start to look at that as a potential target for this trade. So it's a slightly more sort of quick fire reaction to the large order, but it's all to do with where the absorption takes place. You see it down at 60.4, absorption takes place down here. That gives you your clue to buy. Yeah, that initial large offer creates the movement down. The large bid pushes the market up, pulls it back down to the area that they want to absorb. Absorption takes place, and then we release towards the upside when nothing occurs as you move back up towards 61. Much more sort of intricate, this one, and all about sort of seeing that extra absorption down here, and then the market releases further towards the upside. But the basic of that false flip is all about checking where the absorption comes and recognizing whether that absorption is actually happening, and therefore the flip is actually going to work and allow that market to move. So we've looked at a basic flip using large orders, get market trade one way, then trade back. What we're going to look at now then is what I call a layering or a stacking example. And one of the key aspects to this, as it says there, is what I call the float up. This is a situation where a market doesn't trade very much as it moves up or trade very much as it moves down, but instead it feels as if it just trades very little and floats higher. That's one of the key aspects to it. So what will happen is, in an example where a market moves up, it will trade higher with very little trading into the offers. So you see the offers, maybe there's a 200 lot at 300, another 200. One would expect that each time you trade into the offer, there'll be a little bit of back and forth. But instead, when you have this type of action, typically it might trade 100 and the rest of the 200 lot will disappear. And the same at the next price and at the next price. So it trades very easily with very little two-way trade, very little back and forth. Whilst this is happening, larger orders begin to appear following that move up. So you get this light sense, or this light move up, which gives a sense of quite quick market, and then large orders following. Creates the same situation. If you're wondering about buying, you now feel you need to get on with this because of the way the market is trading. So, trades up. What you're waiting to see then is absorption. And typically this might take place over 2 or 3 prices. The difference between an individual basic flip and a layering or stacking strategy is that this moves the market a number of prices, giving the person doing the manipulation more space to then try and get filled. So they absorb over maybe 2, 3 prices, build a position up, and then all of these orders disappear. And at the same time, you now start seeing people selling, hitting market to sell. So essentially, it's a market that trades up on very little, icebergs the high, and then trades back down on very little. But the reason that it does that, or the way that the iceberg can happen, is because these large orders stack up, giving a sense of strength when there isn't really strength. So So the bids will pull. You may even see market flip back the other way, and each time it trades down, you'll get a larger offer come down, tick, 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 tick. And so you could well see that in both directions. That's the idea of a layering or a stacking strategy. This I've seen across multiple markets. You see it in Bund, Euro stocks, DAX. The first time I ever saw this was in FTSE. And this is going all the way back to 2007. So it's a strategy that, or a method of manipulation that has gone on for many, many years and continues to do so. So you can see this across multiple markets. I've seen it in the euro, in oil, in natural gas. It happens consistently. And so if you can recognize this, the key bit is this, the iceberg. After the float, the stacking of orders, the iceberg, you can expect the market to roll back down. It's about seeing this little range. This is where your risk is. Your target is where that float move came from. So let's go and have a look at a couple of different examples of this, and we'll see exactly how it works. Here we go then, let's go and have a little look at this and we'll talk this through. So what we're looking for, larger orders start to appear. And at this point, you start seeing them around about 94. What we then start seeing, if you watch what trades into each of these next few prices, 6, 7, 8, 9. What you end up with is this very easy trade up. So 200, another 200, 240, so slightly increased size. Trading into 6, 97, we say we traded 200, 200. Not seeing a great deal of trade back down. You saw 25 lots there. The market now continues to tick up. You see 96 and we've got a bid. 98, gone, bid. So very, very little trades and we jump nice and easy. 99 trades, 170 and the bids appear. Look now at the offers as well. Sorry, look now at the bids. The bids have increased. We were trading down at 94. You've now got 600, 600, 666, 839. The orders are growing. These are significantly larger than anything else on the offer side. So we've now seen the float up and the beginning of the stacking. What you're looking for now is where does the absorption happen? Look at 00. Now you start seeing a little bit more. We've still got bid, so you're not necessarily thinking I need to get in here. This stacking continues, so it's constantly shifting these 4 orders up. Now 97, 8, 99, 00. But now for the first time, you start to see absorption, offers come back, a little bit of trade down. Trades 00, large order appears once more, trades 02, offer comes back down. And look, the 900 disappears. 500 now starts to be traded. So we're now starting to see the absorption phase and look at those bids. Disappeared. You're now down to 200 at every price. All of a sudden, if you've been buying this thinking, aha, we've got a little bit of pace in the market, it can move higher, your reason's gone. Everyone who bought at 00 and 01 is trapped now. They tried to buy the breakout, doesn't happen, market then rolls back down. And so now all you're looking for is the same kind of movement, roll back down to where we came from, 95, 94, 93. Nice simple trade to take potentially a 4, 5, 6 tick winner. It depends on market that's going to allow you to do this, but it gives you this opportunity. Fair bit of space to move through, market then drifts back down. In terms of target, you're going back to where you started. Stop is beyond the absorption. So in this case, you're going to have a stop realistically probably at 03. But it offers you so much more risk reward than a basic flip, because you can be selling maybe 01, stop at 03 with a target of maybe 6 to 7 ticks. So you've got maybe a 3 to 1 risk reward. And the great thing about the stacking situation is that it gives you so much time to get in. You can increase your size quite significantly on a trade like this, build your position up, get yourself out of the trade, bank some reasonably simple money. Ideally, what you'll get, and I'll show you in the next version of this, you then get the layering back the other way and a market that then rotates up and down within this range. There we see the final little spoof to get themselves out, little reload at 94. This is the end of the trade. You can get out of your trade down there at 94, 95 area. So that's the first example. I'll bring you up now another example where we actually see it move in both directions. This is a much more recent one. So yeah, these are things that will happen over long periods of time, and they'll reoccur every so often. And so once you've learned the skill and you've seen the pattern, you can look out for this in future. So what we have here is now a situation where you've got reasonably even amount on both sides of the book. 700s on the offer, a couple of 700s on the bid, slightly less, and some 500s. So not a great deal of reason to want to do anything at this point in time. Now you start seeing, you watch what happens now. It trades down, we trade 29 quite easily, and watch now what happens at 29. There's a clear bit of two-way directional trade, absorption at 30, which can get you tempted now to want to try and sell. Hence why cursor is just resting over 30. So looking now at the possibility of selling 30 because of that pressure that comes in on it. You've got a few larger orders, but there's not a great deal of reason to be overly keen to sell 30. Whilst it has sold a fair bit there, you've also now got the bid back as well. So this is still in the kind of wait and see phase, what's going to come next. Again, trades down, bid again at 30. So there's some absorption going on at 30. People are trying to buy this. And we just trade up 31. You've got a few larger orders up here, like I say. And so this is just an attempt at trying to play a quick sort of flip over those large orders. But you are seeing this 500 getting traded into. So you can still be happy with this bid on the basis that there has been some degree of absorption happening at around about 30 and now seemingly at 31. So you're just now looking for a little tick up, 32, 3, 4, take your 3-tick winner out of this trade. Nice simple one. And there we go. Just notice there we traded one lot into a 200 and we're now down to 88. The offers are just getting pulled away here on very, very little. We're now starting to see 500s appearing on the bid as well. There's not a great deal of trade into the 32s there at all. 200 trades up, 400 trades, great. So that's giving you the chance of a move. Straight away, trading onto there's a bid. No two directional trade back. Easy trade, bid 33, nice and easy. Does come back on the offer briefly. But see how quick and easy that was to trade 33 and immediately hits into 34. So this is showing you that this market's not got the kind of traction that one might expect. So at this point, you'd be quite happy still with your position at 31. Being a small scalp, you're looking at maybe a scratch or a 1-tick loser if this trade goes wrong. Out of the trade, we've got ourselves a nice 3-tick winner, but we're still not seeing a great deal going on in terms of spoofing one way or another at this point in time. We've seen these kind of little nuances, a bit of absorption down here at 29.30 and 800 or so on the offer, and the market now starts to trade up slightly. Look, all of a sudden, we now start to see it ticks up again. The bids are growing. 700, 600. Back to 84, we now start to see a little bit more absorption coming in. Sorry, I said 84, 34. So you saw 600, 700, they've disappeared slightly. Now you can have another go at trying to sell a bit more. You can now see where we can go back to. We know what happened down at 29.30, there was absorption there. So the way to approach this is you can sell 34, now start putting your offers slightly higher, 35, 36. Your risk is going to be 37, 38. Your target down towards 29 and 30. The large orders are still there. And now we're starting to tick down, hitting into 33. So you can continue to try and build this position up. Each time we hit down, the orders increase again to create this perception of strength. See that very quickly disappeared, 17 traded down and 500 became 300. So this is clearly part of that order being pulled. And now you start to see a little bit of absorption at 33. So you can now move your offers down, increase the position you've got. Now 9 lots short on this trade. So 9 short, waiting for this drop down, waiting for these orders to even pull. Even if they trade through, that's fine. And it could well be in this over a longer period, could be a situation where whoever has this position is actually at the same time as spoofing the market one way or the other, also building up a position one way or another as well. So by allowing themselves to get filled here, they're actually increasing their position slowly and steadily. You see 940 trades now at 33. This does have a risk of going wrong, hence the cursor going higher, ready potentially to get out of this. If it starts to bid up, then this absorption at 33 is clearly a trap, and you don't necessarily want to be in the trade. Still no reason to get out, and there we go. Offered, nice and smooth, nice and comfortable. That's what you were looking for. So now you've got that, you can feel more comfortable on the trade. Looking back down towards those 30, 29, 28 area. You now start to see, as it moves down, the larger orders coming in on the offer more, which is what's creating this little push further towards the downside. There we go, 30s trades. Offers coming back in, you're getting these larger offers coming in again. You can now even consider cutting and reversing this and actually playing the market back up. Hence the increasing the size of the bids down here. 6 lots short, we've got a bid of 9 and 6. Again, you've got more large orders down here as well. But at the minute, the first thought is, can we see this turn to the downside first? And then we'll see what happens once we've traded down here. Do you get the same absorption at 29 as we'd seen before? If you do, then it's going to give you a fill long. And as long as then we start to see these orders pulling, that's going to allow this market to start to rotate back towards the upside. So there we go, you see that order pulled, the 9 changes because we are seeing absorption at 30 and we've got larger orders below. So rather than trying to cut and reverse, change the decision. It's always about looking at what's going on absorption wise and making your decision regarding that. That's what we've seen there, pulls the order, that 6 lot stays, that's where we started to bid up from in the past, but you're not necessarily going to stick with that. So there you go. There's your stacking layering type trades. We see a bit of this kind of drive one way, drive the other way. It's all about the float. That's the bit that you're watching for. When the market floats one way and then you get the absorption. This is clearly an attempt to sort of create a sense of strength whilst not actually showing any strength. Markets that trade up on very little volume, on very few orders, are generally a good indication of a market that doesn't really have the strength that you want. You want to see when a market trades higher, it battle higher. It kind of push to go up. If it's not doing that, then it's just moving because people are getting out of the way. And that's not a sign of strength, that's a sign of a kind of almost vacuum, that anything could float through a vacuum, but put something in the way and it's going to find it much harder to do. And that's the distinct difference that you see between a float up and a real drive towards the upside. Right, final thing that we're going to go and have a look at here. And this is perhaps one of the harder ones to explain, and without seeing this, is a very tricky trade to actually take on. It's what I call a flip with a drill. And the first time I saw this was in the DAX in around about 2012. And the way the trade works, or one of the best ways of identifying the trade, is if you've got a short-term chart. This is a 1 minute chart. You have a short-term chart, and what you get is seemingly in a quiet period, you look at the volumes down here, light volume period, you get these sudden anomalous spikes of volume. This is an indication that something's going on, particularly when you see the candlesticks just have large wicks on them, don't really extend the range in any way. You just get these large sort of wicked candles in the middle of nowhere. Similar kind of idea just here, large spikes in volume, and again just here, large spikes in volume again. No reason for this to happen. And an easy way of working this out, you go and look at a correlated market. If you don't see equal spikes of volume, you can't see any news at that period of time, you know that chances are there's some kind of manipulation going on here. And the way that this trade works is it will start off looking like a basic flip. It looks like the market flips one way and back and up and back and up and back and up and back. But generally it's all done in the same direction. So you get this kind of flip up, flip up, flip up, flip up. Meaning that you can take your kind of simple sell it at the tops, 1 tick winners, 2 tick winners down here. But what then happens is you then get this very high volume, that's this bit, huge volume, drive down. And it seems that the market trades really quickly in both directions. So you see it hits the offer, hits the bid, hits the offer, hits the bid, but it's constantly kind of zigzagging down. That's the way it feels on the ladder. That's your drill part. Now, when this happens, this is essentially forcing price in one direction. The market is not going to be able to sustain this forever, particularly if there's no correlation. Think back to that large order break that we looked at with the Bund and the Tino. When this happens, as soon as that drill stops, the market then jumps back in almost a straight line. So it will trade down for almost every price on the way down, but then it will trade from here to here in an instant, so it jumps. The hard bit about this trade, particularly when you first see it, is having the trust in taking the trade on. The great advantage to this trade is because it does so much volume, the size you can get filled on this is huge. If you've got a market that typically trades maybe 100, 150 contracts in a minute, even less than that in quiet periods, suddenly trades 1,000, you know there's a lot of liquidity there. There's a lot of opportunity to get filled. And we do this in the DAX in 2012. You could get yourself filled 20, 30, 40 contracts on a 10, 15 tick drive down. The market would then stop the drive and jump back up. The hard bit about this trade is as it drills down, you have to buy it as the market drops. That's the way you've got to take the trade on, because you don't know when the jump's going to come. And because the jump is so fast, you cannot buy it as it jumps. The jump is instant. So as soon as it stops, it jumps. So you can't wait for it to stop. You have to buy it as it goes down, creating an average price down here. And then the aim is that the market is going to jump above your average price to allow you out of the trade. I'll give you a couple of examples of this, and we'll look at the initial flip part and how to trade this, seeing it on smaller size, and then once the trade's recognized, increasing size. And also what to do when you get the reversal part wrong and you get in too early. How do you deal with that? And this all comes down to understanding the trade, understanding what you're seeing and the strategy behind it. If you can do that, you can deal with it even when it goes slightly against you, or goes wrong, I should say. So let's go and have a look at each one of these examples. Okay, here we go then. First example. What we're looking at is one of the FTSE in this example, where you're seeing a 98 lot, 100 lot appearing on the bid, and it rolls back down the ladder slightly. So this alerts you, as soon as you see a large order that's starting to move up and down the ladder, straight away you think, right, there could be a trade here. Potentially, we're going to get the chance to sell 28, somewhere around here, for this market to flip itself back down. So not a great deal going on. And as I say, this is first time of seeing it since, perhaps 2012. So no reason to jump straight in, but you start seeing this little pattern. Large order ticks up, quick trade up, flicks back down. So that's what you're watching out for. So once you start to see this gives you the opportunity to trade. Gives you the opportunity potentially to take half a tick, maybe a whole tick out of this market. It's not much, but it's a simple trade that you can repeat over and over and over again. And if you can do this 5, 6, 7, 8, 9 times, you can make yourself quite a significant amount of money just by taking £5s and £10 out of the market. So there you go. Large orders clearly flicking one way than the other. This now gives you the chance to sell more. And one way to try and approach this is to leave your offers in, waiting to see if you can get filled. As the order moves down, you can then sell at lower prices, still constantly trying to take that maybe one tick winner either way. Note now, the large order has disappeared. It started to roll quite a distance away. Market has dropped down from around about 29 to 27, so not a significant movement here. So you're now waiting to see what happens next. Does it come back up? Are you going to get the chance to sell? So continuing to keep your cursor over the offer, ready. If this order jumps back up, you can now have another go at selling. And this is where the patience comes in, but you know what's going on. You've seen this now, you know the pattern. Now you're just waiting to see this come back, give you another opportunity to have a go at this trade. There we go. Large order jumps back up, 27, 27 and a half, 28. Brilliant. And so now you can jump yourself onto the offer, 28 and a half, 28. We've seen this, it tick, tick, tick up and then tick, tick back. So you can now start to see, right, there may be 3, 4 prices you can take out of this trade now. So this is where just seeing that little pattern, the large order comes in and then rotates back, it comes in and rotates back, allows you to take the trade on, and you can actually now have a go at increasing the size on the trade, layering the bids so that you can get flicked out each time and increase your size all the time as well. So we're now 5 short, just up here, waiting for this to now rotate back down. So we've spread the orders out because we've seen this already trade down towards 26. And so we now see that large order back up at 28 and a half. This is the difficult part of a trade like this, that as the large order moves up, there is an element that if this pulls, you may only see it down to 28, 29 and a half, 29. So you do have to kind of accept a few losses on your add-ons. Arguably, what should have happened is they should have sold 30 here, should have sold there more, so that they can then take a winner on the 30s and potentially still get a winner on the original sells at 28 and 29. But nonetheless, still able to take little bits out of this, and this is how you deal with it when it slightly goes against you. You have to try and manage this, take a little bit back out of the trade each time. You don't want to be taking major losses, but the large orders now move down the book and you quickly whip on side. So this gets you out of the trade. Great. So you've taken a nice little winner now, a couple of smaller losers, but now watch the flow come in here. You see the pickup in pace on the book. Watch this constant tick, 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 either way. This is now your chance to buy. So buying more here now, it's 6 now, trades 20, and then it rushes straight the way back up. That's the bit of the trade that you're after. That's the drill phase that you get. Very quick, we trade that all the way down to 20 and almost immediately back to 7. That's where you can really maximize a trade like this. You can pick your size up down here at 20, 21. As it drills down, you start to buy, and then it jumps back towards the upside. You can take 7, 8 ticks on a reasonable amount of size that you can get away at those points. Now, once you've seen something like this, and this is the other key bit to trading any kind of flipper, as soon as you see something like this, there's no need to steadily scale size. If you understand the pattern, you understand it works, increase size quickly. So go from 1s and 2s, go straight to 10s, 20s even. This is how you really maximize any kind of flip, because these trades don't last for a long time. And if you steadily increase, by the time the trade stops working, you're going to be losing on the biggest size. If you go straight to the biggest size, then yes, it will stop working and you'll lose. But you're only losing perhaps the profit from the last trade rather than your largest size, perhaps wiping out the profit from the previous 5. I'll give you a little bit more of an example of this. Okay, so here we go, slightly more size on this one. You see coming into this already 6 short, and then because we've seen that it does rotate a decent distance when this order pulls, now stacking the bids over a larger distance. So trade goes on, little tick down, you're just scaling 1s out all the time. If this ticks back up, you're willing to sell more again. So if the large order moves back towards 19, maybe 20, be willing to sell again. Leave these bids here, and there we go. Trades up, sell another 3. Now you can leave those bids, add a couple of lots down the ladder so that you can get out if this flicks down. But all the time, because we've seen this already, you can now start to increase position on these types of trades. You've got more conviction in the trade. So whilst the previous day it was doing it with 1s, 2s and maybe 3s, we're now up to 8s with the view of trying to increase this further and further. The large order disappears, you get another one out, but it's now a much more willingness to try and have a go at selling each time this flicks up, to try and get yourself out as the market then rotates down. Large order once again starts to move up. Now it's starting to tick down, This is effectively drawing the market down towards 14 now. So you're in a reasonably good position now. As it ticks back up, you can get yourself back onto the bid, reduce the size, get another offer in to try and get filled more at 19.5. So all the time trying to constantly work the whole position, add to it, take some off, add to it, take some off. And this is the art of scalping. It's not just about trying to constantly, take in, out, in, out, in, out. So if you can see the overall direction here, and you can see that drill has been coming frequently recently, you may well get a situation where you're actually short into the drill move, which would be an ideal situation. So just here, still waiting, having sold it from 20s, 21s, now moved the average price down. Now just trying to tick out at around about 18, 17.5. Still willing to sell more on this one, so getting a few more orders onto the offers, waiting to get filled a few more, back up to 5s, constantly just trying to tick a bit either way on this type of trade. And that all comes from seeing it the previous day, seeing the way it does the move. Each time this large order moves down, you can start thinking, is the drill about to come? In this situation, nothing really doing here, but there's no reason to get out. You still see this large order, which has consistently moved up and down. So you're still looking at this as the same trade. It's a much more sort of dynamic trade here. And the only way you'd really want to get out of this is if the large order comes up, disappears, and the market then continues to trade up. That's why you would get out. Here comes the drill then. Quick little flick, 18, 17, 16, 15.5. Nice little flick. There's your first clue, and the mouse goes straight over the bid. Looking now, if this shows signs of that drill type action, that fast pop down, this is the time to now start to try and buy this. So nothing doing just at the minute, but you're ready. Ready for this to come. The large order comes back, over the offer to see if we can sell, doesn't create any action, disappears. Now you start to see this faster action coming in. Still not too quick just yet. But you start to see now we've moved down quite quick, 17, 14, and now you're really starting to see the pace. Straight in, 12 lots this time, no hesitation on this, and then you get this jump back. Because it was a little bit early and the move didn't go all that far, you actually end up with a situation where the jump back isn't too big. You've got an average price that's arguably a little bit too high, and so now you need to just feather these orders out. You've got to accept that you're not going to get as big a move as you might have thought. You're not going to get the 6, 7 ticks that you thought that you got in the previous one. If you got in down at 12s, then yeah, you could have got them. But this is going to make you uncomfortable. And so you're waiting now, just laying your orders up, waiting for the market to go tick, 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 fill them out. It's still not a bad trade. You still made some reasonable money out of it, but it's perhaps not the 6 to 10 ticks that you're going to get every time. And the key bit with any kind of scalping like this is if it doesn't run in the way that you expect, accept that and accept that you're going to be taking a smaller winner, smaller targets on this type of trade. Take those and that's fine. There's nothing wrong with trading it in that way. So there we go, starts to tick up, you leave your orders there, and now it's just a case of patiently getting out. Ideally, you'd be looking at this, hoping for that large order to come back, bid this back up, and you can cut and reverse again. Alternatively, your stop's going to be back down at your scratch. Now, you don't expect this to trade back down, so you stop at a scratch, and you're just waiting for that final flick to get you out of those last couple of orders. So there you have the flip with the drill. Not always the easiest thing to start to trade, but I've got a fair few examples of this. I can give you different versions of this in different markets to have a go at and experience how to trade these things. Manage your risk, manage your stop in real time. Ultimately, you have to define your stop and click out of it manually rather than trying to just click out, or rather than trying to place stops. If the market flicks, you place really tight stops, chances are you're going to get flicked out of these trades. Final one then, real quick, we're going to have a look at an example in the DAX with the Euro stocks at the same time. So let's go and have a look at this one. Final version of flipping and spoofing. Same type of trade, the same drill action that you see in the DAX this time. Here we are then. We don't see the flip beforehand, so that doesn't give you any clue on this one. But nevertheless, you can still look at this trade, and when you see the drill, as long as you recognize that action, you can be ready to trade this. This is something that you should look at and think, this doesn't look right. There we go, trade 81, 79, 78. Nice and quick, very quick sort of flick down, and it's all these 1s and 2s, relentless trade down. Middle of the day, middle of nowhere, no news. So we traded 81, 73, 72, 71, 69, 67, 66. Really, really fast down. 4s, 3s. It's just pushed down around about 15 to 20 ticks in an instant. When you see this type of action, you get this jump back, and that gives you a reason to exit. If you see this, middle of the day, and look at the Euro stocks, note the correlation. Those bids in Euro stocks never get filled, whilst the DAX runs nearly 20 ticks down. Euro stocks can't even do 3 ticks. So it can't tick down to fill those positions in the Euro stock, or fill those orders in Euro stocks, whilst DAX rushes down the page and then springs back up. This is clearly an indication that that is a forced move, the market gets drilled down, and then it pops back up. So again, something to watch out for. And the reason for me illustrating this is that if you haven't seen this, one, it can be a trap that you get short on, and two, having the confidence to play this trade is very difficult unless you've seen it before, to buy into it as it drops. It's a tricky trade to take on, but it's one that gives you the ability to increase size significantly and get a very significant jump. So there we have it. Flipping, spoofing. Key to it always, make sure you're looking at what is getting filled, not just simply at the large order. That's always the key to this. Keep your eyes open for it. We'll look at these. If anyone sees an example, let me know. We'll get it up and we'll go through and have a look at, could you play this and how exactly would you go about doing this? It's a very common thing to see, and it will happen across all markets. Keep your eyes open for it. We'll move on now. We're going to move away from the more absorption side of things and look at the momentum coming into markets.